Welcome to the Estate Planning Made Simple podcast by LSPN, one of the nation's largest and best estate planning networks. The information provided on this podcast does not constitute legal advice. All information, content, and materials available on this podcast are for general information purposes only.
We'll go ahead and get started. Appreciate everybody joining us today. Today we're talking about tax planning, and particularly in light of some of the more recent podcasts that we've done related to tax planning, we're talking about estate tax and the exposure that you may or may not have for estate taxes. In the past, one of the most important reasons to do your estate plan was to avoid estate taxes. Nowadays, most people benefit more from planning around probate, making sure that their family avoids, conflicts, making sure that your assets are going to transfer properly. And estate taxes really is more of an afterthought unless you have a very large estate. And the reason is because we're at an all-time high for estate tax exemption limits in the United States. So, every few years, the law ends up changing on what the credit that you get for estate taxes is. And the way that they calculate the credit is based on what Congress passes and what they say you can have as a unified exemption credits for gift taxes, estate taxes, and what we call generation skipping taxes. Those are all kind of combined. And the total amount that you're able to gift or transfer without taxes is based on whatever the current statute says. So current statute says that it's $12 million per person. And that's because, way back when it was 11.25 million adjusted for inflation, and, adjusted for inflation to 2022 is 12 million per person. The problem is that in the past, we've had multiple different laws, and this has changed over and over again to different limits. And so the current law is going to sunset. That means it's going to expire in 2025. And then the limit will go down to $5 million per person. What that means is that whatever planning you do before the law changes will be grandfathered in under existing law and options, and you won't have to worry about the changes that happen later. But if you have an estate that's over $5 million and below $12 million, or if you're married and you have an estate, above $10 million, but below $24 million, right? This is a very important time to do some planning. So today we're going to focus on one of the strategies that's very common and a very good approach to be able to plan around these potential estate taxes. And some people, have said or may say, well, what's the big deal? If you pay estate taxes, it can't be that bad. And if you think about income tax rates where they start at a 5% and then they scale up, just consider that your estate tax rates start at a 40% and then they scale up. And at the top bracket, you're close to 50%. It's about 48%. The Biden administration has looked at increasing those limits even more. But currently, they start at 40% on everything above those exemption limits. So that gets pretty steep pretty fast. And so the idea of doing planning to be able to remove particular assets from your estate can be very powerful. And especially when we look at life insurance. So, life insurance is exempt from income taxes, but it's included in your taxable estate. The death benefit is even included in your taxable estate limits. And so, what that means is that you could have exposure to estate taxes purely based on what you have in life insurance death benefits, or with that combined with your other assets. And so, therefore, right now the $12 million is pretty high, but to reach a $5 million threshold, there's a lot of our clients that, reach that with maybe a little bit of retirement savings, one or two real estate properties, a life insurance for them and maybe their spouse. All of a sudden you find yourself above $5 million or above $10 million, and it really doesn't take all that much. Well, life insurance is one of the powerful strategies to address this because it provides liquid assets when you pass away. And so that means that your other assets don't just have to be liquidated to pay for taxes, because the taxes are due within 9 months of the passing, right? So, when you set up a life insurance policy to address estate tax exposure, the dilemma is that whatever you put in death benefit on your new life insurance policy that's intended to pay for taxes, well, that death benefit is going to be counted as part of your estate. So now you're adding more taxes. So the way around that is using what we call an irrevocable life insurance trust, commonly known as an ILIT. Your irrevocable life insurance trust is a structure that's an irrevocable trust, which means that once you set it up, you have to give up some level of control, and it's a permanent sort of structure, right? But in return, you get some level of protection. In this case, you get the protection from estate taxes. And you put somebody else, either an independent trustee, in charge of it, or you can set it up with more flexibility so that you can have your spouse be the trustee, for example. We call that a spousal lifetime access trust. Or so that the beneficiaries of it are somebody completely separate from you, and maybe you can retain some level of control in the structure. The idea is that you can't be the person that sets it up, benefits from it, and has control of it. So we have to separate those rights to different parties. But your irrevocable life insurance trust has a few benefits. Number one, it removes your death benefit from the life insurance death benefit value from your taxable estate. Number two, it also removes the cash value inside of your policy, if you have a cash value insurance, from your estate. Number three, it provides you with tremendous asset protection over everything that's inside of your policy. So in some states, your life insurance policy, especially if you have money, growing inside of there for longer than 12 months, it's protected from creditors or lawsuits or other problems like that. But in some states, it's not protected. And it's not protected from a divorce. It's not protected from creditors. It's not protected from other things like that. And so, in order to accomplish greater protection over those assets, you can set up an irrevocable life insurance trust. That trust can have spendthrift provisions. It can have provisions to protect you from creditors. It can make sure that your trustee doesn't have any responsibility to pay any third parties. And so it gives you tremendous asset protection over your life insurance assets that you put inside of it. The other thing that your irrevocable life insurance trust does is that when you establish it and you put your life insurance, you have to change the ownership of the life insurance into it. Then again, it's a completely separate structure, separate entity. It has its own EIN number, it's its own tax paying entity, and your assets can accumulate inside of there according to the terms of the trust. Then your beneficiaries will benefit from it. Some of those beneficiaries will be lifetime beneficiaries. Some of those beneficiaries will be only beneficiaries after you pass away, and the proceeds of the death benefits and life insurance actually pay out. Either way, the idea is that this structure is going to, basically keep everything protected and separate it from any potential taxes and have it there for the future. So when we sit with some clients that have multiple life insurance policies, maybe they have a policy on themselves, on their spouse, maybe on their kids. At times, there is a need to set up multiple irrevocable life insurance trusts to remove all of those values from their taxable estate. So, you can set up one irrevocable life insurance trust and hold all of your life insurance policies in there as long as you have a third party independent trustee and it's set up properly. But if you have children and you have policies on them and you want them to be able to have control of those policies in the future, or you want them to be able to benefit directly from those policies, and deliver control to them and say, okay, this is yours now, you take care of it, it's 100% under your control and I don't have to worry about it. That type of structure requires having a separate trust, because you don't want to transfer everything when you do that, and it makes it a lot more convenient to be able to just put them in charge of their own policies, right? So some of our clients, we've done that for, where we've set up irrevocable life insurance trusts for each of their children, and then one for themselves, one for the spouse, and that gives them the maximum flexibility, especially if we establish it as a spousal lifetime access trust structure, right? And so, the question is, we get this a lot. Um, what's the difference between a spousal lifetime access trust and an irrevocable life insurance trust? And if we're just doing it for life insurance planning for estate tax purposes, there's really not that big of a difference, except the level of flexibility that you have over the assets and who's going to be in control of it. Whether you have a third party, friends, family, an independent trustee or professional trustee managing it for you, or whether you have your spouse managing it for you. And generally speaking, the spouse is going to have a lot more flexibility on what they do and how they do it without having to call or respond to anybody else to be able to accomplish those goals. So that's the big difference between the spousal lifetime access trust and the irrevocable life insurance trust, is the level of flexibility. Before we wrap up, let me share with you guys that irrevocable life insurance trust is one of the things that the Biden administration and not just them, but Congress has really been targeting. And one of the reasons they're targeting it is they say, well, there's so much money that transfers from generation to generation that we're not getting any taxes on. So why are we allowing wealthy families to be able to do this? And so they're targeting irrevocable life insurance trusts to say this should be counted as part of the estate, regardless of whether it's in a trust like this or not. Well, that goes against established principles and established, tax strategies, but they're within their rights to be able to change the law if they decide to. So what they've looked at doing is saying every time that you put new money in to a life insurance policy that's inside of an irrevocable life insurance trust, if you have control over it, like a spousal lifetime access trust, or like a islet that retains some level of benefit to yourself, then every time you put money in, that's going to open up a window of exposure so that your death benefit of your policy can be clawed back or can be brought back into your taxable estate limits. And it will be brought back on a proportionate basis based on what you put in, right? So how do we get around that? Well, there's two things, and of course, some of you may roll your eyes when you hear this, but whatever Congress passes in terms of laws, creative planners will find a way around. Does that make sense? And so that's what's already started to happen. We know kind of where the puck is going, and we've been following it for a while now. So we know that, if they were to make that change, the ways around it would be for us to either just use traditional irrevocable life insurance trusts where you give up pretty much all the control to an independent trustee, or where we actually fund the policy not with contributions directly into premiums, but where we fund it with um, loan amounts that will then pay for the premiums, and then you're just paying the interest on the loans, right? So we call that premium financing, and that can be done internally with your own assets, or it can be done with a bank, with a private lending and so on. But what that does is it allows for the money that goes in to pay for premiums to not be considered additional contributions that would open that window of exposure, but rather it's a loan, and so therefore um, it doesn't get counted the same way, right? And so there are ways to make sure that your irrevocable life insurance trust will continue to be valid, but there are certain terms in those trusts that could also be challenged, and that they could be treated as what they call grantor trusts instead of non-grantor trusts, right? And that's the one that then has that window of exposure. So if you have an existing irrevocable life insurance trust, make sure that you're watching the news, make sure that you're listening to see if Congress actually passes something that could affect or challenge these kind of trusts. If they do pass something, make sure you sit down with a professional that can review your plan and give you feedback and provide you with insights on how you might adjust your plan to stay in compliance. Or if there's not a way to be able to adjust it, then to strategize on how you continue to fund your policy or maybe settle your policy so that you won't have that unnecessary exposure. If you set up a trust and you have an existing policy that you're going to be putting into that trust, remember that when you put an existing policy into a life insurance trust sort of environment, you have 3 hours, sorry, you have 3 years worth of look back period where your policy is still going to be counted as part of your estate. So you don't want to wait to the last minute to set these up, because if you die within the next 3 years after transferring it, it will still be counted as part of your estate if it was an existing policy that you had before setting up these irrevocable life insurance trusts. And along those lines, if the law changes, then that could possibly affect your transfer of the policies, because it'll only be grandfathered in if it was properly inside of your irrevocable life insurance trust before the laws change. So those are just a few things to keep in mind. And if an irrevocable life insurance trust makes sense for your situation, of course, we're happy to help. Meet with a competent professional that can give you good advice on how to properly structure it. And we invite you to explore this type of planning for anybody who is over that $5 million exemption limit that will be changing in 2025. So again, thanks for joining us today. We're going to be sharing a lot more insights and ideas regarding estate planning, tax planning. Next week's podcast will be on legacy planning, and we look forward to sharing more of this information with you.
This has been Estate Planning Made Simple, a podcast by LSPN. Join us next week on Clubhouse and on all major podcasting platforms.